Will the new CPI report bring us closer to a bull run? Bitcoin already made a massive rally of over 20% in the wake of the banking crisis in the United States, and all eyes were on the new inflation data in the US today. The annual inflation rate was 6.4% in January and was estimated at 6% for February. The CPI released today showed inflation at 6%, in line with expectations. Annual core inflation was forecasted at 5.5%, down from 5.6% in January. Today's release was 5.5%. The latest inflation data from the US is bullish, as it could give the Fed room to pause rates or even cut them, and the Bitcoin price immediately reacted accordingly. At the time of recording this video, BTC broke through the extremely important resistance at 25,000 and hit more than 26,000 on Binance at one point. For Bitcoin and crypto, the CPI print couldn't have been much better. Bitcoin is rallying as financial stability risks sent treasury yields crashing. In a scramble to avoid another massive bank run, federal regulators stepped in as some Americans grew skeptical of traditional banking. The movement over the weekend possibly came as a surprise to traders who may have otherwise bet on declining prices after two key crypto-friendly banks were shut last week, and USD Coin, USDC, a major stablecoin, depegged. Over 100 million worth of Bitcoin shorts or bets against a rise in prices was liquidated on Monday. This was the highest liquidated amount since January 14th, when a Bitcoin surge caused $500 million in liquidation across several crypto futures. Monday's liquidations meant 78% of all Bitcoin futures traders took on losses. The losses were spread mainly over crypto exchanges Binance, OKX, Huobi, and Bybit. Liquidation refers to when an exchange forcefully closes a trader's leveraged position due to a partial or total loss of the trader's initial margin. It happens when a trader is unable to meet the margin requirements for a leveraged position, fails to have sufficient funds to keep the trade open. Large liquidations can signal the local top or bottom of a steep price move, which may allow traders to position themselves accordingly. Bitcoin prices rose as U.S. bank stocks dropped steeply on Monday, exacerbated by fears of a similar bank run on regional outlets following last week's collapse of Silicon Valley Bank. The crypto ecosystem was built on the belief that not one entity, meaning a bank, should be in charge of one individual's finances. But until that becomes a reality, traditional banking will likely have to serve as a bridge between centralized finance and decentralized finance. Thus, the shutdown of Silvergate Bank, Silicon Valley Bank, SVB, and Signature Bank will certainly cause headaches for the industry in the short term as many crypto companies search for new banking partners, uncertain if larger entities will even want to touch crypto companies anytime soon. For now, it's not clear what new financial institutions will partner with these crypto companies in the wake of Silvergate, SVB, and now Signature, said Ilya Volkov, CEO of uHodler, a Swiss-based international fintech platform providing a variety of Web3 crypto and fiat service. In the long run, however, this contagion shouldn't hurt the crypto industry, as there will likely be other smaller banks that will likely bridge the gap. Crypto liquidity is likely to take a hit in the short term, but this is an opportunity for new innovative challenger banks to step up and take the place of SVB, Silvergate, and Signature, said Andrei Grachev, managing partner at digital asset market maker DWF Labs. Are we heading into a bull market? A lot has happened over the last week that changed the macro environment completely. Crypto reacted extremely bullishly today to the news that the Fed is providing liquidity again after the failure of Silicon Valley Bank and Signature Bank. Here are the main 5 factors for the possibility to head into a bull market. 1. Fed bails out depositors. During last weekend, the Fed announced the Bank Term Funding Program. Depositors will have access to all of their money starting Monday. This decision effectively marks a return to Fed liquidity injections, also called quantitative easing. Instead of pulling money out of the economy, they are injecting it back in. This basically means putting the money printer back on. Bullish for risk-on assets. 2 is the Fed interest rate pivot. Goldman Sachs economist Jan Hatzius said, "In light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its next meeting on March 22nd. As interest rates are usually bearish, this means temporary relief. 3. The huge BTC pump. BTC jumped more than 20% over the last days. The Fed liquidity announcement entirely erased any trace of the Silicon Valley Bank implosion. 4. USDC regains $1 peg. After the collapse of the Silicon Valley Bank, the second largest stablecoin lost its $1 peg. Monday morning, the peg was entirely regained. Many people regained confidence after an entire weekend of fear. And lastly, 5. Binance buys $1 billion worth crypto assets. While this technically doesn't have an effect on turning the market bullish or bearish, it does provide buy pressure. Binance had $1 billion worth of assets in their own stablecoin. Due to the recent changes in banks and stables, they decided to convert this to mainly BTC, ETH, and BNB. $1 billion is a lot of money for Binance to be spending. Bitcoin's market cap is now around $500 billion. It is still lonely at the top for Bitcoin. Even with all new sorts of crypto coins gunning for that top spot, Bitcoin stays number 1. It is still a long way to go to get to all-time high prices of $69,000. But if the market keeps pumping, eventually we will see the price of Bitcoin hit $100,000 in the future. Surely. If you want to invest in Bitcoin, the best method is to dollar cost average. Dollar cost averaging is the practice of regularly investing a fixed amount of money regardless of the token price. This is a good way to develop a disciplined investing habit, invest more efficiently, and possibly reduce stress levels and costs. Dollar cost averaging can also help keep your emotions from hurting your portfolio. For example, if you invest a large amount of money in one trade, you are more likely to regret it if the trade goes bad. Behavioral economists note that most people are inherently loss-averse. They tend to react more strongly to losses or the likelihood of them than to gains. However, with dollar cost averaging, you invest small amounts of money over time, making it easier to absorb poorly timed investments. Let's say you invest $100 every month. If the market goes up, $100 buys you fewer tokens. But if the market goes down, your money buys more. Over time, this strategy can lower average prices per token, compared to what you would have paid if you bought all the tokens at once, when they were more expensive than average. And that's a wrap for this video. Let me know in the comments if you agree that we are going into a bull market soon. Please remember to dollar cost average if you are attempting to invest in Bitcoin or any other cryptocurrencies. And of course, there are many other promising projects out there, so be sure to do your own research before investing. Thanks for watching, and don't forget to subscribe to our channel for more crypto-related content.